Welcome back to the deep dive. Today we are putting aside the usual tech trends and pop psychology.
Taking a bit of a turn.
A big turn. We are putting on the trench coats, grabbing the magnifying glasses, and stepping into a world that, it exists in the shadows of the skyscrapers.
Metaphorically speaking, of course. Though I do like the image of us in trench coats.
It sets the mood.
Yeah.
Because today we are role-playing as the financial detective. When we look at these massive financial hubs, and specifically we are looking at Gift City in India today, it is so easy to just see the glass, the steel, the high-frequency trading.
It looks pristine.
It looks pristine. It looks efficient.
Injects stability. I mean, that's the whole point of the architecture, isn't it?
Exactly. But inside those servers and in those quiet boardrooms, there is a hidden war being fought.
Mm-hmm.
It's a war against money launderers, against, drug cartels trying to clean their cash, and terrorist financiers trying to move funds across borders.
And unlike the movies, this war isn't fought with car chases or explosions. It's fought with data. It's fought with due diligence.
Right.
And it is fought with the specific regulations we are unpacking today.
Right. So for this deep dive, we are taking a stack of documents from the NISM IFSC 01 certification course. But we aren't reading the whole book, not even close. We are zooming all the way in on Chapter 5, the IFSCA Anti-Money Laundering, Counter-Terrorist Financing, and Know Your Customer Guidelines 2022.
It's a bit of a mouthful, I admit.
It is a mouthful.
But if you peel back the dry legal title, this document is essentially the rule of engagement for that war we just mentioned.
I'm genuinely excited to peel back the curtain here, because usually when we think of financial crime, we think of like The Wolf of Wall Street or Ozark.
The Hollywood version.
The Hollywood version. But the reality of stopping dirty money from turning clean happens right here in these guidelines. It's about spotting the needle in the haystack before it, pricks you.
That's a really great way to put it. I often frame this discussion not just as a list of rules or boxes to tick, but as the immune system of the International Financial Services Center, or the IFSC.
The immune system. I like that analogy. Break that down for me.
Well, think about it. The financial system is a body. Capital money is the blood flowing through it.
Okay.
And it has to flow freely for the body to survive. But money laundering, that is a virus. It tries to hijack the healthy cells, the legitimate banks and insurers, to replicate itself and hide.
So these guidelines are the white blood cells? Is that where you're going with this?
Precisely. They are the antibodies. They are the shield that protects the integrity of the entire financial system. If this chapter fails, if these guidelines are ignored, the whole body gets sick. The reputation of the financial center it collapses. That
sets the stakes pretty high. I mean, it's not just about filling out a form correctly.
Not at all.
It's about keeping the entire system alive. So, okay, our mission today is to decode this immune system. We need to figure out who exactly is responsible, the so-called regulated entity.
Yeah.
We need to understand the massive shift from rule-based to risk-based policing, which seems to be the core philosophy here.
It is the fundamental shift of the last decade, absolutely.
And we are going to get into the nitty-gritty mechanisms. How do you actually spot a suspicious wire transfer? What are the specific red flags? How do you stop money from getting to a terrorist cell? It's heavy stuff, but we're going to break it down.
We certainly are.
So let's start at the very beginning. Section 1, the core identity. In this document, they keep using this term regulated entity, or RE. Who are we actually talking about here? Is this just the big banks?
That is the common assumption. You picture a teller behind a glass counter. It's a massive multinational bank.
Yeah.
But in the context of the IFSCA and these guidelines, the net is cast much, much wider. A regulated entity is essentially any unit or entity that has been granted a license, recognition, or registration by the IFSCA.
So banks, obviously. But who else falls under that?
Well, insurance companies, capital market intermediaries, stockbrokers, investment advisors, portfolio managers, alternative investment fund. I mean, if you are operating within the IFSC ecosystem under their license, you are a regulated entity. You are deputized in a way as part of that immune system.
Okay, so if I'm an RE, I have these obligations. But within the company, who is actually on the hook? Is this something the CEO can just, delegate to a compliance officer in the basement and wash their hands of it?
And that is the most common misconception and, frankly, the most dangerous one. Chapter 5 shuts that idea down immediately.
Okay.
It operates on the buck stops here principle. The guidelines explicitly state that senior management is responsible.
Senior management, so the C-suite, the people flying first class.
The C-suite, the board of directors. The guidelines say they must exercise due skill, care, and diligence.
I like that.
You cannot delegate this away and say, oh, I didn't know. Compliance isn't just a side department or a cost center. It has to be a culture.
A culture.
A culture driven from the absolute top.
That's a huge responsibility. It basically says if dirty money flows through your system, it's on you because you didn't build a strong enough dam.
Precisely. And to build that dam, the guidelines outline what we might call the 3 pillars of duty in Clause 5.2.
Okay, let's walk through those pillars. What's number 1?
Pillar 1 is policy formulation. The RE must have a written AML CFT policy that's anti-money laundering and counter-financing of terrorism. And this isn't just a draft on a laptop.
Right.
It must be formally approved by the governing body.
So it has to be official. It's a mandate, not a suggestion.
It is a binding mandate, yes.
Yeah.
Pillar 2 is the KYC policy. Know your customer.
Okay.
Interestingly, the guidelines state this must be embedded within the AML CFT policy.
No.
They aren't separate silos. Knowing who you are dealing with is the foundation of preventing any kind of laundering.
Which makes perfect sense. I mean, you can't stop a criminal if you don't know who the customer is in the first place. So what's the third pillar?
Management accountability. As we just touched on, every single member of senior management is on the hook. It ensures that compliance is a boardroom conversation, not just an operational detail buried somewhere.
So it forces the question.
It forces the question, are we safe? To be just as important as are we profitable?
I have to ask, though, and I'll play the cynic for a second, is this just a tick box exercise? Do companies just download a template, get someone to sign it, and file it away to keep the regulators off their back?
The guidelines are designed specifically to prevent that. I mean, that's why there is such heavy emphasis on the approval process and the involvement of the governing body.
I see.
It demands a culture of compliance. If you treat it as just a tick box exercise, you are almost guaranteed to fail the risk-based requirements we're about to discuss. A template doesn't catch a sophisticated money laundering ring.
No.
Only a culture of vigilance does.
That's a perfect segue. Let's talk about that risk-based approach, or RBA. This seems to be the brain of the whole operation. Chapter 2 of the guidelines is all about this. So, what is the philosophy here? How is it different from the old way of doing things?
The philosophy is really about efficiency and effectiveness.
Yeah.
In the old days, and we're talking maybe, I don't know, 15, 20 years ago, compliance was often rule-based.
Right.
You treated every client roughly the same. You asked for the same ID. You made them fill out the same forms, regardless of who they were.
Which sounds democratic, but maybe not very smart.
Exactly. It's incredibly inefficient.
Yeah.
Why would you treat a grandmother opening a savings account to put away $50 a month with the same level of scrutiny as, say, an international arms dealer trying to move millions through shell companies?
Right. You're wasting your time harassing the grandmother while the arms dealer just slips right by because you're swamped with paperwork.
Precisely. The risk-based approach says, treat clients based on the risk they pose. The main objective is to identify and assess money laundering and terrorist financing risks that are specific to your clients, to countries, to products, and even your delivery channels.
So it's about resource allocation. It's smart allocation.
That is the essence of proportionality. The guidelines state the approach must be objective and proportionate. High risk equals enhanced due diligence.
You dig deeper.
You dig deep. You ask more questions. Low risk equals simplified due diligence. You check the basics, and you move on.
It sounds like detective work. You put your best detectives where the crime is most likely to happen, not on every single street corner.
Exactly. You don't put a SWAT team on a jaywalker. You save them for the bank robbers.
Now, the text mentions something called an enterprise-wide assessment. That sounds massive. What is that?
It is massive. And it's not just looking at one client. It's about looking in the mirror at the whole ship. The regulated entity has to assess risks across all its business units and all its product lines.
So they have to ask themselves the hard questions.
The really hard questions. Where are we vulnerable? Is it our private banking arm that deals with wealthy, powerful people? Is it our new crypto asset desk? Is it our geographic exposure?
And this isn't a one-and-done thing, right? The world changes so fast.
Correct. The review cycle is strict. These assessments have to be updated at least once every 2 years. Or, and this is the key part, when a material trigger event occurs.
A material trigger event. Give me an example. What does that mean?
Well, a merger. You buy another bank, you've just inherited all of their risks.
Oh, of course.
A major change in legislation. Or maybe a big geopolitical event. A war breaks out, a country gets sanctioned, and suddenly a jurisdiction that was safe is now a high-risk zone for terrorist financing. You can't rely on a risk assessment from 2024 to protect you in 2026. The world doesn't work like that.
That leads us right into the business risk assessment in Chapter 3. This is where the RE has to really scrutinize themselves.
Yes. This is the inward-looking part. They have to ask, what is the nature, size, and complexity of our business? They have to look at very specific risk factors.
What kind of factors are we talking about here?
Well, geography is a big one. Country risk. Are we doing business with jurisdictions known for, lax AML laws or corruption? Customer type is another.
Right.
Are we dealing with a lot of politically exposed persons or PPs?
Right.
And, of course, product complexity. The more complex a product, the easier it is to hide money in it.
I noticed a specific point in the notes about new technologies. This feels very relevant to our listeners, especially in a fintech hub like Gift City.
This is a crucial point, and it's where these guidelines are actually very forward-looking. Criminals are early adopters. They love new tech.
Oh, for sure.
They love crypto, anonymizing tools, complex fintech products. The guidelines mandate that the regulated entity must assess the risks before launching a new product or using new tech.
So preemptive strikes. You can't just launch some new AI-driven payment platform and say, oh, we'll figure out the security holes later.
Exactly. You have to anticipate how a criminal might exploit your shiny new toy before you even take it out of the box. If you don't, you are essentially building a brand new high-speed highway just for them.
Okay, so we've built the immune system, we've assessed the risks. Now let's get to the actual detective work. Section 3. Suspicious transaction reporting, or STR. This is the if you see something, say something part of the show, right?
It is, but seeing something is a lot harder than it looks.
The guidelines define suspicious pretty broadly, don't they? It's not just about, someone walking in with a bag of cash.
No, and that's a vital distinction. It includes attempted transactions.
Oh, wow. Explain that. What does that mean?
It means if someone comes in, they try to move money, they get spooked by your questions, and they leave.
Yeah.
That is a suspicious transaction.
Even if no money actually moved.
Even if zero money moved, yes. Think about it. If a guy walks into a bank, asks how to wire $100,000 to a known tax haven without showing any ID, and then literally runs away when the teller asks for a passport, you don't just shrug and say, oh, well, he didn't do it. You report that activity.
Because he's probably just going to try the bank next door.
Exactly. And the guidelines offer a structured way to think about this. It's a 4-step identification process.
Let's walk through those steps. What's step 1?
Step 1 is to detect a suspicious indicator. This is usually a red flag. Maybe the transaction makes no economic sense. A student with no declared income is suddenly wiring $50,000.
Right.
Or maybe a business that deals mostly in local cash is suddenly receiving huge, complex wire transfers from offshore.
Okay, so the red flag is spotted. What's step 2?
Ask the customer questions. Don't just guess. Sir, can you tell me the source of these funds? What is the purpose of this transfer? Be direct but professional.
And if they get all sweaty or vague, what's step 3?
Review the customer's records. Look for patterns. Is this normal behavior for them? Do they have a history of this? Check your database, see what you know about them.
And finally, step 4.
Evaluate all the information. Put it all together. Does the story they gave you hold water? Does it align with their history? If not, you probably have reasonable grounds for suspicion.
Now, let's say I'm a teller or a relationship manager, and I've gone through these 4 steps. I'm suspicious. Who do I tell? Do I, call the police? Do I hit a panic button under the desk?
No, you do not call the police, and you definitely do not tell the customer.
Okay.
You report internally to the principal officer.
The principal officer. We'll talk more about them later, but for now, they are the internal point person, the hub for all this.
Right. Employees must notify the principal officer if they have reasonable grounds for knowing or suspecting. Then, the principal officer, who have the bird's eye view of the whole institution, decides if it needs to go external.
And the external reporting, that goes to FIUIND.
That's right. The Director, Financial Intelligence Unit, India, FIUIND. They are the central nervous system for all financial intelligence in India. They connect the dots.
What are the timelines here? I assume you can't just sit on this information for weeks.
No, not at all. For an STR, suspicious transaction report, it must be filed within 7 working days of the principal officer being satisfied that the transaction is, in fact, suspicious.
7 working days. That's tight.
It is. Speed is of the essence in these investigations. There is also the NTR, Nonprofit Organization Transaction Report,
Right.
and that's filed by the 15th of the succeeding month. Nonprofits are, unfortunately, often used as fronts for terrorist financing, so they have their own regular reporting cycle.
Now, you mentioned something really important earlier about not telling the customer. The tipping off role. This feels very spy movie.
It's extremely serious. It's a criminal offense.
Yeah.
I mean, if I suspect you are laundering money, and I ask you some probing questions, and then I say, hey, just so you know, I'm filing a report on you with the government.
You've just blown the whole case.
I've just ruined the entire investigation. You'd flee. You'd destroy evidence. So the guidelines emphasize strict confidentiality. The RE and its employees cannot, under any circumstances, tip off the customer. It puts the employee in a tough spot. They have to maintain a poker face.
That's fascinating human drama right there. You have to keep smiling at this person, maybe make up some bureaucratic excuse for a delay.
Oh, the system's a bit slow today.
Right. The system's slow, while secretly you're in the back flagging them as a potential criminal. That's intense.
It's very intense. And it's not just bankers. The guidelines are clear that lawyers, notaries, and accountants are not off the hook.
The professionals.
The gatekeepers. If they engage in financial transactions for clients, managing assets, creating companies, buying real estate, they have the same reporting obligations.
So you can't hide behind your accountant anymore.
The net is very, very wide. If you are helping move the money, you are responsible for checking where that money came from.
Let's move to Section 4. We're going global now. Correspondent banking and wire transfers.
This is where the financial system gets incredibly complex. This is the plumbing of the global economy.
First off, correspondent banking. I always struggle with this one. It's the bank for banks, right? Is that the simple way to think of it?
That's the best way to describe it, yes. Imagine you are a small local bank in India. Your client wants to send money to a vendor in, say, Peru.
Okay.
You don't have a branch in Peru. You don't have Peruvian sol currencies sitting in your vault.
So I'm stuck. My customer can't pay their vendor.
Unless you have a correspondent bank.
Yeah.
Usually a massive international bank like a Citibank, a JP Morgan, or an HSBC that has relationships and accounts in both places. They act as the bridge. They are the correspondent bank, you are the respondent bank.
Okay, so they are the middleman moving the money. What's the risk here? Why is this such a focus?
The risk is distance and anonymity, in a way. The correspondent bank is doing business with your customers, but they have never met them. They've never seen their ID.
So they are relying on me.
They were relying completely on you, the respondent bank, to have done the proper KYC.
I see. So if I'm a sloppy bank and I'm letting criminals open accounts, the correspondent bank gets infected with that risk without even knowing it.
Exactly. It's like that Russian doll or shell game analogy. The criminal is hidden inside the local bank, which is then hidden inside the correspondent transaction. It creates layers that obscure the true source of the funds. And that is why money launderers absolutely love this mechanism.
And this is why the guidelines specifically ban shell banks.
Yes. A shell bank is a bank with no physical presence and no real supervision. It's a ghost ship.
A P.O. box with a bank logo.
Basically. There's no one to audit, no one to arrest. REs are strictly prohibited from entering into any relationship with a shell financial institution.
There's also this term payable through accounts. That sounds convenient, but also really risky.
It is. It's extremely risky. A payable through account is where the respondent bank's customers, the end users, can use the correspondent's account directly, almost as if it were their own. It's like giving your house keys to a friend of a friend.
Yikes. I wouldn't do that.
And banks shouldn't either, without due care. The correspondent bank has to ensure that the respondent bank has properly verified the identity of all those customers. You need to know who is holding the keys to your house.
Now let's talk about wire transfers and the travel rule. I love this name. It's so simple. Information must travel with the money.
It's vital for tracking. It's the whole point. You can't just send a bag of cash digitally with no return address.
So what are the specific requirements? I know there's a threshold involved, a dollar amount.
Yes, specifically for cross-border transfers. The magic number is USD 1,000.
Okay, let's drill down on that. So if I'm sending, say, $500 to my cousin overseas, what info needs to go with that?
If the transfer is below or equal to USD 1,000, the transfer needs the originator's name, their account number, and the beneficiary's name and account number. The basic identification.
But what if I'm sending $10,000 to buy some equipment?
If it is above USD 1,000, the requirements ramp up significantly. You need all of the above, PLUS, the originator's full address, an official ID number, or their date and place of birth.
So you need to be able to fully, uniquely identify who is sending that money.
You cannot be anonymous. Not with larger sums.
That's a very clear line in the sand, $1,000. And for domestic wire transfers within the country.
Similar requirements.
Yeah.
But there is a little caveat. If only the account number is sent with the initial transfer, the ordering institution must be able to produce the full originator information within 3 business days if it's requested by law enforcement or another bank.
So you have to have the data ready to go, even if you don't send it all up front.
It has to be on file and immediately accessible. Yes.
Okay, so what if I'm just a bank in the middle, an intermediary bank in the chain?
Yeah. That's the intermediary's burden. If you are just moving the money along the chain from Bank A to Bank C, you have a duty to keep all that information attached. You can't strip the tags off the luggage as it passes through.
And what if the information is missing? If I get a wire transfer coming in with no originator name?
Then you have a serious decision to make. Do you reject the transfer? Do you suspend it and ask for more information? You have to apply your risk-based approach. But just accepting a wire transfer with no name attached, that's a massive red flag.
It's like accepting a package at the airport from a stranger.
You just don't do it.
Okay, Section 5. We're going inside the fortress now. Internal policies, compliance, and audit. We mentioned the principal officer earlier. Let's unpack that role. You called them the sheriff.
They are the sheriff. The principal officer, or PO, is the designated authority for the entire AML program within the organization.
Okay, but can, say, the sales director be the PO? I mean, they know the business and the clients best, right? You think that would make sense?
You would think so, but absolutely not. And that is a critical point about conflict of interest. The sales director has a target to hit. Their job is to open accounts, to bring in business, to increase volume. The compliance officer, the PO, their job is to vet those accounts, to ensure safety.
So their goals are fundamentally opposed.
They are in direct conflict.
Yeah.
If the same person does both, safety almost always loses. Profit always wins in the short term.
So the PO needs independence.
Independence and authority. The guidelines are clear. They must be at management level. They must have timely access to all customer records. You can't hide files from the sheriff. If the PO asks for a file, they get the file. Period.
Now, there's also mention of a designated director. Is that the same person as the PO?
No, it's a separate role. The designated director is a board-level individual. They are responsible for ensuring overall compliance with the broader PMLA, the Prevention of Money Laundering Act, obligations.
Okay, so one is operational, the other is strategic.
That's a good way to put it. The PO is the day-to-day operational head. The designated director provides strategic oversight from the board.
And then there's the audit function. I guess this is the who watches the watchers part.
It is. The audit function checks if the immune system is actually working. And importantly, the guidelines say they shouldn't just check the transactions. They must review the content and the frequency of staff training.
Training, the human firewall.
You can have the best AI software in the world, the best systems, but if your frontline staff, the tellers, the relationship managers, don't know what a suspicious transaction looks like, you will fail.
So what do you train them on?
RE must train employees on the laws, like the PMLA, on their own internal policies. And this is key on typologies.
Typologies, that's a fancy word. What does it mean?
It just means the current methods and trends in crime, knowing what the bad guys are currently doing. Are they using crypto mixers to obscure funds? Are they using trade-based laundering through fake invoices? Are they using online gaming tokens to move value?
So you have to train your staff on the current playbook of the criminals.
Exactly. It's a constant arms race. The criminals evolve their methods, so your training has to evolve right alongside them. If you are training your staff on schemes from 1990, you are completely vulnerable today.
That makes a lot of sense. Okay, Section 6. The watch list. This is where it gets into national security. We're talking about sanctions.
This is where anti-money laundering crosses over into counter-terrorist financing. The guidelines reference Section 51A of the UAPA. That's the Unlawful Activities Prevention Act.
This sounds really intense. This isn't just about tax evasion anymore, is it?
No, this is about preventing violence.
Yeah.
The RE has a legal obligation to ensure they hold no accounts for any individuals or entities that are on specific terror lists.
And which lists specifically are we talking about?
The guidelines point to the UNSC, the United Nations Security Council list, specifically the ISIL, Daesh, and Al-Qaeda sanctions list, and the 1988 sanctions list, which primarily covers the Taliban.
So, practically speaking, what happens if a name from the Taliban sanctions list pops up in your customer database? What do?
You freeze. Immediately, you freeze the account, you report to FIUIND, and you advise the Ministry of Home Affairs. This isn't just about compliance anymore. This is about stopping money from reaching people who will use it to buy weapons or fund attacks. The stakes are as high as they get.
And this isn't just a one-time check when you open the account, right? These lists change.
All the time. No, it's ongoing screening. Every time the UN updates those lists, the regulated entity has to check their entire customer database again. It's a constant, never-ending state of vigilance.
Finally, Section 7, the paper trail, record keeping. The old saying, if you didn't write it down, it didn't happen.
Or in this world, if you didn't write it down, you can't prove you did your job properly.
So what's the golden rule for time? How long do we have to keep all these records?
The 6-year rule. Records must be kept for at least 6 years from the date the business relationship ends or from the date the transaction is completed.
6 years. And what are we keeping? Is it just the ID card copies and the account opening forms?
No, it's everything. The CDD, or customer due diligence, documents obviously, but also detailed transaction records, sufficient to reconstruct the individual transaction from scratch. You need to be able to replay the tape for an investigator years down the line.
What about those internal notes? I think this is suspicious analysis that we talked about earlier. Do you keep that?
Yes. Internal findings on suspicious analysis must be kept, even if you ultimately decided not to file an STR.
Wait, even if I didn't file it, why?
Especially if you didn't. You need to be able to prove why you decided it wasn't suspicious. That is your insurance policy. If 5 years later that client turns out to be a major criminal, you can show the regulator. Look, we investigated him on this date, we asked these questions, we documented our analysis, and based on the information we had at the time, he looked clean. It shows you were diligent.
That's a really, really good point. It's about showing your work, not just the final answer.
Exactly. And accessibility is key. The data must be retrievable easily and quickly. And even if you keep records offshore, say on a cloud server outside the IFSC, they must be accessible to Indian authorities without any delay. You can't say, oh, the server's in the Cayman Islands. It'll take us a month to get the data. That just doesn't fly.
Wow. Okay, let's try to unpack this whole deep dive. We've gone from the highest level, the duty of senior management in the boardroom, all the way down to the nitty-gritty of specific data fields in a single wire transfer.
It's a comprehensive framework. It has to be. The criminals are sophisticated. The defense has to be too.
What really strikes me is the direct connection between what feels like boring paperwork, the policies, the records, the fields, and the real-world impact of stopping crime.
That is the why. That's what you have to remember. It's all about integrity. It's about ensuring that a place like Gift City and the IFSC are safe harbors for legitimate business, not playgrounds for criminals.
And for you listening, whether you're in finance or law or you're just a curious learner, this stuff really matters. It shows the fundamental friction between ease of business and security.
It does.
We all want fast transfers, we want instant accounts, but we also want to stop terrorists from getting funded. You can't always have both.
Exactly. And every time you have to fill out a KYC form, every time you wait an extra day for a large transfer to clear, you are paying a small time tax for the security and integrity of the global financial system.
Before we go, I want to leave our listeners with a thought. We talked a lot about the risk-based approach and the central role of the human principal officer.
Yes, the judgment call.
The judgment call. But the criminals are using AI now. They're using crypto mixing services that can move and obscure money faster than any human principal officer can possibly think. They are automating the act of laundering.
That raises a fascinating and somewhat terrifying question. The current system relies so heavily on human judgment, the principal officer's suspicion, the teller's gut feeling. But with the speed and volume of modern tech, is a human-led, risk-based approach fast enough? Or will we eventually need AI to police the AI?
Will the principal officer of the future just be an algorithm?
It's a very real question we'll have to face.
That is a thought to mull over. And for you listening, maybe think about your own risk assessments in daily life. Who do you trust and why? What's your process?
Indeed.
Thanks for joining us on this deep dive into the immune system of finance. Stay curious, stay vigilant, and we'll catch you on the next.